The fallout from COVID-19 remained a key issue this quarter, with the crippling effect of the economic shutdown becoming apparent. But despite this fragility, equity markets recovered, and the main driver was the aggressive stimulus response from policymakers. We now see that some countries are handling the pandemic better than others, and unfortunately South Africa has drawn some criticism with poor follow-through from a good initial response. The equity markets showed somewhat of a disconnect to the current economic picture. South African equities were the best performing asset class and had their strongest quarter in 20 years. Resource companies performed particularly strongly, most notably the precious metal stocks, but a rebound in Sasol and continued strong performance from Naspers and Prosus also contributed. Global equity delivered good performance driven by developed markets, and the US in particular, which was driven by a narrow segment of their market. Even South African listed property received a boost from deeply depressed levels. Bonds, which typically lag when risk appetite is strong, were up, benefiting from lower interest rates and disinflation. Global growth is experiencing a significant setback, with unemployment having risen and sectors like tourism, travel, and hospitality taking strain. The IMF has lowered its growth forecasts, and global growth is now predicted to decline by 5% in 2020, with a similar rebound the following year. They also expect South Africa's gross domestic product to shrink more significantly by 8%, with a muted rebound next year. It's clear that the global recovery will be uneven, and that some regions will feel a lasting impact from the current turmoil. South Africa started the year on a weak footing, and prior to the lockdowns was already in a recession, with high unemployment and strained public finances. The situation has therefore worsened, with even lower economic activity and greater financial commitments resulting from the government's much-needed stimulus response. The SARB has lowered rates and eased financial conditions, assisted by falling inflation, and this has helped to support borrowers. During the quarter, National Treasury delivered an emergency supplementary budget, which showed that the fiscal deficit will rise to 15%, while debt to GDP will exceed 80% this year. The current situation is untenable and requires decisive action coupled with improved growth. However, confidence at this stage is at an all-time low. As always, we try to find the balance between positioning to achieve client return objectives and protecting capital. Risk is therefore only taken on when we are being sufficiently compensated for it. This calls for appropriate diversification, while also being cognizant that there's a spectrum of potential outcomes that could play out. So at a high level, the portfolios remain overweight global equity and underweight local equity, which we think faces greater challenges. We also remain constructive on South African bonds, which are offering reasonable compensation for their risk. Thank you, and for more information on our current thinking, please read the latest edition of Talking Points available on our website.